Thank you very much, and good morning. I'd like to thank, first of all, the organizers for their very kind hospitality. I was supposed to be joined by two colleagues, and unfortunately, I'm here all alone. I have more time, actually, at this podium, and I would really like to encourage you to ask questions, to interrupt. I don't mind if you interrupt and ask questions during the presentation. My subject, I'm a very strong fan of airport privatization. I've spent the last 25 years helping either acquiring airports or helping clients, governments structure these transactions. So as Alex Lay has said, there is no model that fits everyone. And I'm very fortunate to have had the experience of working in different countries, different regions, on different types of transactions, and I hope I can convey part of that experience to you today. Again, I really do encourage you all to participate and ask questions, make comments, challenge. I always like that. To get started, this presentation may be a little bit more technical in terms of airport financing. And may I just have a show of hands of how many people have been involved in actually financing an airport investment project? Okay, good. So it's good to know. So essentially, like any project, there are different sources or options for financing. The first is that if an airport is a company, then it will have retained earnings, and it may use these earnings to finance certain projects. These tend to be smaller types of projects, for example, a baggage handling system or gates or so on. And so this would be a form of self-financing its capital investment requirements. The other, which is typically the case for public companies, for example, ADAC or other companies like that, which are publicly owned, they usually would go to the Ministry of Finance, present their project, that gets into the cycle of the public budgets, and then eventually it would get financed. And usually this is a fairly long process because it really involves a lot of decision makers. And very often also, in some cases, the Ministry of Public Works or some other entity is actually the one that's executing the project. So the owner itself of the project doesn't normally get what they want. It's like playing telephone, where you say a word to someone and someone and someone, and you end up with something a little bit different than what you expect. In many cases, whether it's public or private, the project sponsors can have access to commercial debt, can have access to, so that would be sort of commercial lending from banks or a syndication of banks, or they can sell bonds, or in Islamic financing called sukuk. And the largest, I think, in the region has been Jeddah Airport, where there were, it was a few multiple billion-dollar sukuk SARs for the development of the new Jeddah Airport. Another source of financing is multilateral organizations such as the World Bank, the European Investment Bank, the African Development Bank. And a good case of that is the Cairo Terminal 3, where the government went to the World Bank and borrowed quite a bit of money for that development, and that normally involves a sovereign guarantee. Export credit agencies as well, in the case where there are systems or equipment that are being bought from a certain country, and the export credit agencies, the ECA of that country, then is financing the project to support exports. And finally, and we've heard a lot about this in the previous session, the PPPs, where the private sector is invited to varying degrees to take an equity stake in the project and to finance the project, but also to develop it and operate it for a long period of time, usually between 25 and 40 years. So usually it's more related to the life cycle of the assets that are being privatized, which typically is about 30 years. So it's usually around that period. This is a bit of a complex chart, but I'd like to go through it in fairly amount of detail. And this is basically the heart of the transaction and the various players that are involved in such a transaction. And you can see from all the contracts and agreements that the lawyers make a lot of money in these transactions. But at the beginning, the government, which is essentially called the grantor, so this is the department or the agency of the government that has the responsibility for the project, issues an expression of interest, an RFP, that basically says, we have this requirement, and we would like, and these are the rules of what we want. These are our expectations. This is the absolute scope of it. These are the obligations. And I'm happy to share these slides with anyone who would like it. So don't worry about taking pictures. And if you are qualified enough, you are welcome to come and take, to have a role in this. So the grantor then invites companies who are the shareholders, usually private sector, sometimes involving, usually involving an operator. There was a good question about whether the local capacity of investors, and the answer is yes, and it's important, I think, for international investors to have a local partner because they understand the nuances of the politics and they can get things done. But at the same time, local investors who are not involved in aviation also don't have a propensity to accept traffic risk, because normally in the Middle East, they're used to some sort of an offtake where the government is guaranteeing payments for services. So for them, traffic risk is something that is very complicated to understand, and it's a risk that they're not used to. But eventually, they're becoming more and more comfortable with it. So the shareholders establish a project company whose sole purpose is to develop and manage and finance this project. So this is what they call ring fencing. So the rules are very clear as to what the asset is, what the obligations are, and what the performance standards are. And that ring or that circle has to be very clearly defined for the project to be bankable. There cannot be any gray areas about it. So the SPV company, of course, gets equity from the shareholders, and that equity can be in the form of an equity bridge loan. So essentially, there's a corporate guarantee to banks to provide the equity portion of the project, which is typically about 25–30% in airports. It hardly is more than that, because of the traffic risk component, and the rest is coming in the form of debts called senior debt. So the shareholders contribute equity, and over time they expect dividends from that project company. Normally those dividends happen usually at the end of it's more back-ended in the concession. At the same time, the project company as an entity then starts negotiating the concession agreement. It, first of all, of course, develops the proposal and so on, and then it presents it once it's selected, starts negotiating the concession agreement, and as a result of that, of the bidding process, the concession fee is determined. So, for example, in Amman and in Medina Airport, it was more than 50% of gross revenues are given to the government as a concession fee in exchange for the right to operate and make money from that valuable concession. At the same time, the project company, in addition to the equity that they get, also can borrow from the lenders, or a syndicate of lenders, what is called the senior debt. So senior debt in the sense that it is senior to other payments, and we'll talk about the waterfall later on. But that's basically the loan that it gets, and in return, it has to provide debt service. It has to pay the interest of that debt as well as the principal over time. And it's usually about 15 to 20 years is the loan agreement, but I'll also talk about that later. In addition, the lenders have an agreement with the grantor, which is called the direct agreement, in case there's any form of default by the project company. So imagine there's a termination for convenience. The government decides that they really don't want a private operator, and they change their mind and want to take it over for national reasons, for strategic reasons, for defense reasons. Then they can basically step in, compensate the project company and the shareholders, and take over that asset. But at the same time, the lenders, this would not be bankable unless the lenders were guaranteed that if that event happens, that they would be compensated by the government. So essentially, the government takes over the obligations of paying that loan back to the banks. The other event, of course, if the project company is non-performing, and the government wants to get rid of it and bring someone else to replace it, then also the banks are, so in all cases, the bank loans are guaranteed through this direct agreement with the government. Very often the grantor itself is a civil aviation authority, and it doesn't really have the balance sheet to support some of the obligations in the concession agreement, especially when it relates to taking over the obligation of the banks, but other things as well. And in this case, typically, there's a Ministry of Finance guarantee, although we're seeing less and less, or more and more resistance to that. There's a Ministry of Finance guarantee that guarantees, it backstops the obligations of the grantor under certain circumstances. The project company itself, in addition to the loan agreements that it has with the banks, also has other relationships. One of it is the EPC contract. So essentially, they have to go to a construction company and say, we'd like this built. And a lot of the obligations in the concession agreement that are related to the construction, delays and things like that are passed on to the EPC contractor. Very often, the EPC contractor is a member of the consortium. And I have a personal view that this is not desirable, but it also, on the one hand, it reduces the risk to the other investors to have someone on board who is taking risk. But on the other hand, there is seldom an alignment of interest between the shareholders, which can be financial or an operator, and the EPC contractor, because typically the EPC contract wants to exit as soon as they finished the construction. And so there's a bit of a misalignment, and I hope we as an industry can find a better way to handle this type of misalignment. The project company also has an agreement with an operator, an O&M agreement, whereby the obligations of the concession agreement in terms of standards, in terms of all of these things, but particularly standards and safety and performance standards are handed over to the O&M company. Typically, the operator is an investor in the SPV, so it's up at the shareholders level, as well as they have a contract to operate the airport on behalf of the project company. And they receive, under that contract, O&M fees. There's an upside in case they do extraordinarily well, then they get an upside, but also they are penalized in the event that they don't. They fail to meet the obligations. And normally this is a back-to-back. So typically the project company will not retain any risk in the same way that it doesn't retain risk when it comes to the EPC contractor. So if there's something, basically if they have to pay a fine, they will get that fine from the O&M operator. The operator itself has various contracts with suppliers. For example, baggage handling system, cleaning, all sorts of systems, CETA, all sorts of systems that are in the airport. But it also has commercial relationships with the food and beverage, duty-free, shops, parking, you name it. So also there are sub-concession fees. So I consider those to be sub-concession, and these sub-concession fees are then collected by the operator. They go to the project company, and we will see later the waterfall, how that money is, all these gross revenues. But the most important source of revenue, of course, is the passenger fees, as well as the airline fees. And so those are usually regulated by the government. Those account for about 60 or 70% of the gross revenues of the project company. And I would also like to add, as an addendum to the sessions that happened before, I think one of the weaknesses in our part of the world is the issue of regulation, economic regulation especially. This is an area that requires a lot of work because as an investor, if you're investing for 25 years, 30 years, 40 years, you really want a lot of clarity as to what will happen. For example, if the security agencies tell you that you need to introduce very expensive equipment, you need to have mechanisms that would allow you to recover that because it's a kind of a force majeure. It's something that was unexpected. And of course, you as an operator have the incentive to grow traffic, but we also know that traffic, the traffic is of course related to some extent to the price elasticity of demand. So it's important to have, first of all, regulation, and it's more important to have good regulation. Sometimes we have regulation without having good regulation, and that harms us as an industry in general. Have I left anything out? Are there any questions up to this point? Great. So there's one here and one there. I would be happy if you could introduce yourself as well. There's one here.
Hi, good morning still. Steve Moreland, Abu Dhabi Airports. On your point regarding Ministry of Finance and government guarantees as backstops, do you find that is generally on a risk-based approach based on the country risk or based on the airport risk? Do you see a differentiation between those who are less inclined to offer and those who are more inclined to offer? Basically what I'm saying is, the riskier the deal, the greater the guarantee of government intervention or not?
The country risk is important in the context of countries that don't have a strong enough credit rating or where there is a lack of regulation. So if there's an arbitrariness in for example, passenger fees, I don't know of any government that will not retain the right to step in an airport, because those airports are considered strategic assets, they're considered national assets, they're considered assets for defense purposes. So ultimately, there needs to be a form of guarantee by the government, either through a resolution of the ministers of the prime ministers or the ministers' council, which is what happened, for example, in Amman airport, or through the Ministry of Finance backstop, which was in Medina Airport. But ultimately, there should be some form of a sovereign guarantee. The scope of that guarantee can vary from depending on the context of that. In other parts of the world, for example, when I worked on JFK Terminal 4, that wasn't necessary because the government did not require that, or Brisbane Airport, because the courts were sufficiently robust and the investors had a good sense that they could get their rights back, so they didn't need these kinds of guarantees. So it does depend on the context and the development of law and the confidence of the banks and the confidence of the operators or the shareholders. Please.
My name is Tamam Dandashi. I'm with Atkins SNC Lavalin Group. Just have a question and a comment. You mentioned that we can challenge one of the thoughts about the DB JV or the contractor being part of the financial shareholders of the project company.
I was expecting that.
How do you think, don't you think that with the current trend in the market where big construction companies are exiting the fixed price, date certain lump sum EPC contracts, how would that impact the project finance or the project finance industry or the PPP space? And how would you ideally align the interest between the contractor? Don't you think an alignment with the contractor and the financial investors in terms of some equity injections from the contractor with an pre-agreed kind of equity cap or equity IRR ceiling for their investment in line with the financial investors?
The problem is timing. When you pre-qualify as a consortium, you normally will have an EPC contractor on board. So this is the pre-qualification phase before you start your conceptual designs, before you're already pre-qualified. And so you're already stuck with a shareholder whose price ultimately, because normally the design and the BOQs and the pricing happens at a later stage, very close to the time that your bid is submitted. So you don't have time to shop around once you already have a design and once you've priced it. So you're stuck with an EPC contractor on board. And you have to take that price from that EPC contractor, and believe me, it always happens last minute. In some cases, we've used a quantity surveyor to try to rationalize that number. But at the end of the day, what happens is you're always at the risk that shareholder who you've pre-qualified with will withdraw, and that shareholder will spoil the consortium because you're not able to substitute at that stage. So a lot of it is a problem with process and how late it is that you get the CapEx the CapEx estimate from your contractor, because that normally happens really a week or two before the submission is due.
Competitive markets where you have an established process and you have an established kind of procurement process. For example, the Canadian model. We've seen a lot of bidders bidding on PPP projects where there is a long-term kind of relationship between a developer or a fund manager alongside the contractor who's part also of the financial shareholders of the SPV. Would that be a little bit different than compared to the market here?
I would prefer to see a RFP process that allows you to pre-qualify with 2 or 3 contractors. And then during that process, you can drop 2 of them and keep 1. I think from the perspective of the shareholders who will survive for the next 25 years or 40 years in the concession, because the contractors do exit. I don't know a case where a contractor has stayed for a very long time. I would rather see a case where I have, as an investor, the ability to choose between 2 or 3 contractors. I think that's a better model for the governments and a better model for the shareholders, the non-EPC shareholders. But as I said, I think we as an industry need to find a solution for that. I don't have the solution. I've just seen the problems associated with having an EPC contractor on board that can basically, I won't say blackmail you, but you're at their mercy whether or not you can submit a bid based on the number that they give you, and you really have no way of negotiating. You have no negotiating leverage once that happens. But I'm open to discussion. If there are no more questions on the previous slide, the key success factors, there will be a session tomorrow afternoon, and I'm honored to moderate it. Alex Lay from IFC is going to be also a speaker, as well as others. But essentially, I think from the perspective of the grantor, they really have to be very absolutely clear what their expectations are in terms of minimum technical requirements, how large the facility is, trigger points for expansion, performance levels, and of course performance levels here, this is an area that is a bit complicated because your performance as an airport operator depends on the performance of agencies that you have zero control over, like immigration, like customs, like ground handling companies. And to the extent, like the airline itself. So to the extent that you don't have control over certain processes or technology that's used, it's very difficult for you as an operator to guarantee. Of course, so that essentially becomes a gray area. And of course, the grantor doesn't have the right to go to immigration and say, you have to do A, B, C. And actually, that's someone mentioned Changi Airport. I think one of the advantage or the successes of Changi Airport is they have a ministerial level committee where the Minister of Interior sits with the Minister of Civil Aviation, and they dictate the standards of the government agencies that are involved. We haven't really seen that. I would say probably Dubai Airport is a good example where there's a lot more alignment between the different service providers than any other airport that I've traveled through in the Middle East. So this is quite important to clearly define what it is that the government needs and wants. And one of the issues that we faced in Medina, for example, is the issue, and I think it's a big issue in the Middle East, is the issue of staff. What do you do with the staff of an airport that are an inefficient airport? People were hired because of social reasons, people are not qualified, there's the WASTA factor, things like that. And then when you give it to the private sector, you expect the private sector to be efficient, but you tie their hands and you're not able to enable them to be efficient. And this was probably one of the biggest obstacles we had in Medina Airport, because the transaction closed in 2012 in the middle of the Arab Spring. And the government told us, you know, take it or leave it. So we understood, of course, the sensitivity of the situation, but I assure you, in most countries, developing countries, this is a big issue. Africa, Arabia, etc. And it's especially significant in countries that are wealthy countries, because the motivation for privatization usually is not because they need money. Saudi Arabia did not need money to bring a consortium to build the airport. They had the money. They needed the know-how. And so to tell citizens, we have to let you go, although we have the money to do it ourselves, also politically is a bit difficult. I had that experience because also I was leading the corporatization of ADAC in 2007. And it was very hard, especially in Abu Dhabi, very wealthy Abu Dhabi, for the government to tell the staff there, we don't need you. They were all nationals and so on. So those are some of the issues that are real issues that the government usually, the grantor usually will face. And I would say in our part of the world, labor is one of the biggest obstacles to privatization. The other thing is the operator. The operator really needs to understand this business. This is not a business. This is not a business that should be done by someone who doesn't have experience. We've seen a lot of cases. So besides being able to understand project finance and strategy and operations and maintenance and development, what it means to enhance airport revenues, the drivers, risk mitigation, everything that's written here. I think it's important also to understand the culture of the operator. You see cases in the Gulf, I will not mention names, where some operators have come from Asia. They're fabulous at operating their airport in Asia. But they are not able to transform that experience to the country that they are at, because the whole basis for their whole foundation is very different. Kids in their country stand in a straight line when they are 3 years old. That will never happen in our part of the world. So there are certain cultural issues that are really not transferable. So you do see operators who are amazing back home, but when they come to our part of the world, they basically are not able to transfer that know-how locally. And everyone, I think, at the end has to be very flexible, because when you talk about negotiating a 25 or 40-year concession, no one knows what's going to happen tomorrow. So everyone, although everything is written down and the lawyers have reviewed it, etc., so many uncertainties are in our business that we need to be very, very flexible about adapting to the realities. We cannot be really reading it by the book. And so that's an area that's quite important. And this should be fair, by the way. And there needs to be a fair and clear allocation of risks and obligations, and also a very robust mechanism process. So it's not, if I were a grantor, it's not in my best interest to insist that the operator do something that is beyond their ability to do it, just because it's written in a contract. So essentially, this is why they call it PPP, public-private partnerships, and I think my experience with Medina was amazing. I had a counterpart who was very understanding. We had a very open dialogue. In areas where I could accommodate, I did. In areas where he could, he did. Ultimately, though, there is the constraint that that person or that entity is a public entity, and how to protect that relationship from some form of abuse. But at the end of the day, also that balance needs to be stricken, so that there does need to be flexibility on both sides. And I will give the example of the staffing of Medina Airport during the Arab Spring. We were very flexible. Our contract said that we could dismiss people that we did not feel we needed, but we kept it because there was flexibility. We didn't want to lose the transaction, and we understood the problem from the perspective of our public sector partners. So a lot of goodwill is necessary to make this happen. This is not just about writing a contract and walking away. No way. You need to actively manage these contracts. So let's look at the sponsor's perspective. As I mentioned, the sponsors create a special purpose vehicle whose only purpose is to operate under that concession agreement and have those assets. It really doesn't matter whether it's a BOT, BTO, etc. At the end of the day, as I said, the government will always step in. So governments prefer it to be BTO. The asset, once it's constructed, is transferred. That gives it more, I would say, confidence. But at the end of the day, whether it's a BOT or BTO, it doesn't really matter. They will come and take your assets. I remember when I was at TAV, we were about to open Imam Khomeini Airport in Tehran, and we saw the tanks coming towards the airport, and we thought it was part of the opening ceremony, but they actually showed up and said, out. So our whole staff had to leave. That's the reality of things. This was quite a while ago, 2005, if I remember correctly. Usually, as I mentioned, in terms of equity, it can either be provided upfront, it can be done over time on a pro rata basis, or it can be back-ended. It can be actually cash that the sponsors provide, or the banks are usually happy to provide you with an equity bridge loan but that has a corporate guarantee, so the companies themselves need to be able to stand behind that. Very often, the consortium is asked to take over an existing airport while they construct the new airport. And so the revenue from operating the existing terminal is usually, can be considered as pre-completion revenues, and it can act as a contribution towards the equity of the shareholder. Normally, as I mentioned, the equity contribution, talking about leverage, is about 30%, and that recognizes the risk associated with the project, because normally the demand risk or the traffic risk is borne by the consortium itself. So they need to put enough money in the game so that they can feel the pain when there is pain in the project. So it's about 30%, and 70% comes in terms of debt. The sponsor also has to provide all sorts of LCs. I will not go through them. But one of the LCs that is important is the debt service reserve account. So basically, and I'll talk about debt service, the debt service ratio, but basically it is a ratio that is about 1.3 to 2 times the monthly payments to the banks. So basically the banks want to make sure that you have enough money in a bank account and in a reserve account to cover any operating losses in a bad year. And so that money is put aside in the same way that a maintenance reserve account is put aside, because let's not forget these assets are essentially owned by the grantor, and they want to make sure that you are maintaining the airport in a good way. But let me ask you, if you're in the last year of your concession at an airport and you have to replace this light bulb, would you replace it with a long life light bulb, or would you replace it with a cheap one that will go out within a year? So these are some of also the complexities of maintenance in a concessioned airport that needs particular attention. I mentioned termination. Essentially, the sponsor, if the sponsor defaults on its obligations, the government has the right to step in, either to take over the operation itself, but in case it's really a poor performance and they haven't met its obligations, then usually the equity will be lost by the sponsors. So that's the price to pay if you don't meet your obligations. While, of course, remembering that the banks will always be protected under the a different agreement, the direct agreement with the government. In terms of risks, in our industry, traffic is the largest risk. It doesn't mean that it's fully carried by the sponsors. There are cases, for example, in Ankara Airport. It was a small airport when TAV was awarded it, and they wanted to build a very nice airport because it was the capital airport of the country, 8 million passengers, although the traffic was quite low. And so there was an availability payment or a subsidy, whereby the government said, build it, oversize it, gold-plate it, let's say, and we will cover the shortfall between the actual traffic until you reach 7 million passengers. So there was a form of subsidy that was related to traffic, such that the investors did not carry the full risk of traffic. And this will happen in regional airports, where that serve a social function, that don't make money and will never make money. Usually that threshold is about 1 to 1.5 million passengers. And the government will probably say, come and operate these airports if they are not bundled with a profitable one, and we will compensate you for any losses that you incur over time, because we need that airport. And rather than us operating it, and it'll cost us 100, let's say, because we are inefficient in doing it, come and we'll pay you 60 to operate it. So at least it's a win-win. The government saves money, the performance probably improves, and the private sector has something to do as well. The grantor also has certain risks that are usually retained for the grantor during the concession agreement: political risk, economic risk. Imagine the economy, something really serious happens in the economy, and the revenues of the operator are in local currency. You see now some countries going through that, like Lebanon, for example. Imagine if the landing fees were in Lebanese lira. I'm not picking on Lebanon, but it's just an obvious example right now. Or change of law. Imagine that the government decides, for example, in Portugal now, where I live, the concession agreement basically allows the operator to increase aeronautical fees as the traffic goes up. It's kind of counterintuitive, because we're an industry that has economies of scale. So as traffic goes up, your unit cost goes down in our industry. But their concession agreement allows them to increase unit revenue as the traffic goes up. And now the EU is looking at this issue. And if the EU were to decide that this is not legal, then the operator, the investor, will have the right to be compensated by the state for that loss of revenue. So that's a change in, an example of a change in law. In terms of debt financing, the borrower is that SPV company, which is created by the sponsors. It's usually limited recourse financing. We hear a lot in our industry about non-recourse financing. There's really no such thing as non-recourse financing. To the extent that the shareholders are carrying any risk, it's limited recourse. So there are certain caveats where the shareholders will be responsible, for example, losing their equity in terms of a form of a default and things like that. The banks are very clever. They want their fees up front. So, and I will also tell you that Medina was Islamic financing. In my opinion, it doesn't vary. There's not much difference between Islamic financing and traditional financing. Basically, there are fees and so on, and it's basically a different formula, and they're collected in a different way, but ultimately, I think there's no distinction. The terminology is different, but they get their fees like everyone else. They're not really a shareholder or a quasi-shareholder. And just to let you know, in Saudi Arabia, we had the option of going traditional or Islamic, so we had both options. It's just that the Islamic banks were flush with money in Saudi Arabia, so it was cheaper for us to go with Islamic financing. But the government allowed us to go with traditional financing if it was more beneficial for the project. The banks really do a lot of work studying the project. They have legal advisors who are usually very good. They have traffic and technical advisors who are usually very good. And believe me, they go through everything. And whatever traffic forecast we have or whatever CapEx, they really temper it quite a bit. In terms of talking about the region, I think one of the challenges that I've always faced in the region is that the banks, they were used to financing projects that had a corporate guarantee, for example, a factory or something like that, or oil and gas projects or water projects or power projects where they were basically offtake type. So the government would say, thank you, would say, take this project and we will give you this much, whether we consume power from your plant or not. So it was quite good for the banks because they basically had a government guarantee to pay. In the case of airports, that's usually not the case. And so it takes banks a long time if they don't have experience with taking that volume risk or traffic risk to get their minds around it. I was just told I have 10 minutes, so I'll try to jump around a little bit. The tenor of the contracts of the borrowing is usually 14 to 20 years, but at the same time, the margins are usually very high during the construction period because the project is riskier during that period, and then they drop, and then they start going up. They step up because the banks are encouraging the refinancing. And it's actually in the interest of the sponsors to refinance after the construction because you can usually get better rates because you've had a few years of operation, you have a better balance sheet, you've gotten rid of the construction risk. So usually there's an incentive to refinance after maybe a couple of years after the construction. And the cash sweep allows the banks to basically, if you're making returns that are higher as an operator, that are higher than expected, they can come in and take that money and as also a means of allowing you to have a longer tenor. So it works both ways. The debt service coverage ratio basically is an important indicator, and that allows you, that gives comfort to the bank that you are generating free cash before more than you are required to pay them after you pay all your bills. I won't go into a lot of these details because I'd like to get to the waterfall, but there are extensive undertakings on behalf of the sponsors as well as on behalf of the government. You cannot get rid of your assets, you cannot sell before a certain number of years, you cannot make investments before you get their approval, you cannot go borrow additional money from somewhere else, you can borrow from them under certain circumstances. Reporting, they want to know everything about your project, and normally they have their Advisors take a look at your construction reports, your operations reports, your operating budgets, your audited accounts. It doesn't mean you need their approval for the budgets, but it means that they need to understand what you're going to do, and it's consistent with your financial model that was submitted to them. And they have security over everything. It's like borrowing from a bank to buy a house. They own the project until you repay them. So you're totally naked in front of these banks, which is a safeguard for them. This is probably an important slide because the project company generates gross revenues, about 60% from aeronautical sources, passenger fees and airlines, and 40% from commercial sources. The percentages may be different depending on the country. And so in order of priority of how do you use that money, first of all, is put in an account that the operator cannot touch. So it's controlled also by the banks, and you can disperse from that account according to this level of priority. The first thing you have to pay is the concession fee to the grantor, which is around half. So already half of it is gone. Then you need to pay your operating expenses, payroll, insurances, electricity, all of that, and your taxes. And then that's why it's called senior debt. And then you pay the banks for the interest and the principal that you've borrowed from them. And then there are other mandatory prepayments that you have to do to the banks. And then there's the maintenance reserve account, so they want to be sure that the assets are protected for the duration of the agreement, so that you're spending your money as you told them on maintaining these assets. And of course, the government is also very concerned about that. The debt service ratio account, so this is a pot of money, like a savings account, in case you have a bad year, then you can tap into that account and pay the banks. Voluntary prepayments, if you want to prepay your principal, you're able to do that, and the banks encourage that. And then finally, the money goes to the shareholder distribution. And the shareholders can either keep that money as retained earnings in the company or not. I will stop here. And if you have any questions, please, I invite you to ask. Are we okay with time? Okay.
So first I introduce myself. I'm Simona Franco, working for NG Aviation. We are doing the digitization for the airports and NASPs. Thank you so much for a very nice presentation. I'm not really professional in this topic, but it's really huge. I mean, that's if I saw the structure, how many organization is involved in the process, it's very demanding, I presume. But the question is that usually you are hired by airports or private sector for the privatization of the airport, and how you see the differences to deal on the different sides. So what is the difference? What is the main, let's say, a main aim from the two different sectors like private and public?
First of all, it's nice to see you again. You're asking me individually as Waleed. I'm very fortunate to have worked both sides. I used to work for the International Finance Corporation, the World Bank, and so I was very much involved in structuring these transactions, working with governments, and trying to translate their needs into something that would be bankable. And as Alex said, for example, I was leading the Amman airport privatization at the beginning before I left IFC. And they had this Norman Foster design that was very expensive. I remember traveling 5 times to try to convince the government to give flexibility to the bidders because the roof was too expensive. And Jordan is not a very rich country, and there was going to be no subsidy. I also have worked on the other side. For example, 8 years as the chief strategy officer of TAV Airports, and I was involved in a lot of the acquisitions. It's a total different skill set. And I've also worked leading transactions on behalf of investors like Bangalore or other places like Brisbane in Australia. For me, I think it's fascinating to see all sides. Today, when I look at a transaction, in the past, maybe before IFC, I would say, oh, this is crazy. What are these people thinking? And then when you start working with the government and you understand that the government is not this homogeneous entity, there are different considerations going on. Some of them you will never understand as a foreigner, or some of them are just related to a strategy of a country or an ambition of a country. I think it helps put things into perspective when you see the other side, and sometimes your counterpart at the government also is not a decision maker. So I think seeing all sides of it really helps a lot to understand. I'll give you another example. In Medina, we discovered that the borrowing capacity of an airport, when we go to the banks and we say, we need to borrow, what was the number in Medina? It was 700, the total project size was 1.2 billion US dollars. And we borrowed 720 million from the banks. But when we first did our financial model, we found that the debt service coverage ratio, the ratio of how much money we will earn compared to our obligations to the banks, was lower than 1.2. Our DSCR was 1.2. Which meant in the first 3 years during the construction period, which meant that we can borrow less. If we can borrow less, then we can offer the government less because our equity portion had to be higher, and the WACC, the weighted average cost of capital, would be higher, meaning that we were not going to be able to offer the government as much as we would have liked. So we went to the government, and maybe this helped that that IFC was on, Alex was on the other side. And I explained to them the situation that if you allow us to only pay 50% of the concession fee in the first 3 years so that we can borrow more money from the bank, then we can increase the share to the government. And so it was a win-win for the government. The only difference is it's a cash flow issue, that you will get less in the first 3 years, but you will get more for the next 25 years. And I think that helped a lot to have worked on both sides. So I think sometimes it's important to have this, I mentioned flexibility, but I'm really very fortunate to have worked on all sides, and I'm blessed actually, because I love this industry.
Thank you for the interesting presentation. One thing you mentioned that in Singapore, it's easier to work because they work in their own environment. Well, their environment is different. The airport is deregulated. The regulation, the open sky policy is very valid. In countries you mentioned, it's very regulated. Medina Airport,
Yes.
India. So obviously, you will not be able to increase your revenue if you have a cap.
I think the area of economic regulation really needs to be carefully studied. Generally speaking, I don't think that aeronautical fees are cost-related in our part of the world, which is what ICAO requires in document 9082. So essentially what needs to be done is the cost of the airport needs to be understood, and very often you don't have proper accounts for the airports in terms of, and of course you have a lot of room to reduce operating expenses, and there needs to be, the principle of cost relatedness is not implemented. So I think in our part of the world, the prices, the charges are high, but they are not based on the cost. There's a bit of a disconnect between both, and I think that needs to be carefully examined, keeping in mind that ICAO allows pre-financing of projects, and I think that's something that is not understood. If you have a capital project, you can start collecting today for a construction that will happen in 3 to 5 years. So it's not just the actual operating expenses, it is also the future. What they call PFCs in the US and in other places as well. You can start collecting fees in anticipation of a project. So we tend to be regulated from a safety perspective, but the numbers that I've normally seen in our part of the world are just essentially arbitrary numbers. And sometimes they're just based on the history. They don't want to increase fees too much. I remember in Medina when GACA introduced at the airports in Saudi, it was, if I remember correctly, it was 50 SARs per departing passenger. And because Medina had this special case of being a Hajj and Umrah terminal, people would arrive in Jeddah and leave from Medina or vice versa, they introduced it both ways as 80 SARs. But I do not believe that that number was arrived at through any computation. I think that's an area where I would like to see a lot more work done.
If you allow me, Medina Airport was a domestic and converted into international, but it was also promised that it would be an open sky agreement. Therefore, the operator would be able to make more money. But when GACA steps in and says it's regulated, restricted bilaterally, you cannot increase your revenue as an operator. And goes on for many airports around this part of the world.
Exactly.
Thank you.
No, I fully agree with you. And in fact, I was on the board of Medina and I introduced slot coordination, level 2, during Hajj, because we had a lot of problems with capacity. They were not actually related to peak hour capacity of the airport. They were mainly related to scheduling of the airlines, especially airlines that were coming from certain parts of the world that were not very, the aircraft were always breaking down, it seemed. So I think it's a related issue as well. Thank you. Any last questions, if you'll allow me? Thank you very much for everyone.